Hi students, this is a video for Financial Accounting 1, Accounting 1100. And in this video, we are going to be going over some problems very similar to your homework problems for Chapter 7. Many of you have already expressed some frustration, concerns on doing the problems for Chapter 7 inventory. So I wanted to put this video together and kind of walk you through some of the problems and how to solve for the problems. So we're going to go ahead and get started. Now, the biggest part of Chapter 7 is talking about the different cost flow methods for keeping track of inventory. So we have the FIFO, the Lifo, and the weighted average. And this first problem is asking us to provide the gross profit for each three methods, as well as the ending inventory. So quickly, gross profit. Gross profit, again, is your total sales minus your cost of merchandise sold. All right, so let's get started on the first one, A, which is your FIFO. FIFO is first in, first out. So what FIFO basically means is the first units purchased are assumed to be the first units sold. First in, first out. So the ending inventory is going to be made up of your most recent purchases. All right. So let's look at here. We have, during the month of April, purchased 3 units. Okay. And each time we purchased, the cost of the unit was different. So the first purchase we made on April 2nd, the cost of merchandise sold was $286. The next purchase we made on April 14th, the cost of merchandise was $289. And the third purchase made on April 28th, the cost of the merchandise purchased was $292. All right. Now it says, assume that 1 unit sold on April 30th for $379. So I want you to determine the gross profit for April and the ending inventory on April 30th using the 3 cost flow methods. So the first cost flow method is first in, first out. Again, first in, first out is the first units purchased are assumed to be the first units sold. Therefore, your ending inventory is going to be made up of your most recent purchases. So with that said, if we only sold 1 unit, then the 1 unit we sold in April, we're going to assume was the April 2nd purchase of the unit that cost $286. So if we come down here, we can see the equation for the first in, first out. The total gross profit is $93. So you take the sale price of $379 and subtract out the cost price of $286, giving you a gross profit of $93. Now, the next question it asks you for FIFO is, what is the ending inventory? Well, your ending inventory is made up your most recent purchases. So your most recent purchases would be the ones on the April 14th and April 28th. So you would take the cost of those purchases, the $289 plus the $292, and you can look down here and see the equation. You add those together, and that equals $589. And that's the total value of your ending inventory in April. So again, FIFO is first in, first out. So the FIFO cost flow method assumes that the first units purchased are the first units sold. Therefore, your ending inventory are going to be comprised of your most recent purchases. All right. So with 1 unit sold, then we're going to assume it was your first unit you purchased, which is the one you purchased on April 2nd. Your ending inventory is going to be comprised of the 2 units you purchased April 14th and 28th, because those would be your most recent purchases. All right, so let's move on to LIFO, which is last in, first out. Now, LIFO means that the last units purchased are assumed to be sold first. So this is the opposite. So instead of the first, it's the last. All right. And therefore, the ending inventory is made up of your first purchases. So if that's the case, Now let's look down here to this equation. We take the sale price of $379 and we're subtracting out $292. Why? Because it's last in, first out. So you're assuming that the last item you purchased is the first item sold. Okay, so if the last item you purchased on April 28th at a cost of $292. So the sale price of $379 minus the cost price of $292 gives you a gross profit of $87. Okay, now how do we calculate the ending inventory? Well, because it's LIFO, last in, first out, your ending inventory is going to be made up of your first purchases, which will be the purchase you made on April 2nd and the purchase you made on April 14th. So you would add 286 plus 289. You can come down here and you can see the equation where we added 286 plus 289. So our ending inventory for the LIFO method is going to be $575. Now, weighted average is different, okay? It takes the average cost of all available units purchased is applied to the number of units sold and in the ending inventory. So in this situation, they've kind of done the math for us right here. So you take all of the units cost and add them up, which is total up to be $867, okay? Then you take the total cost of the units and divide it by the total number of units. So you would take 867 and divide it by 3. You see right here, they did that, 867 divided by 3. So the average cost per unit is $289. All right, so then what you're going to do down here is you're going to take the total sale price, which is $379, and subtract out the average cost per unit, which is $289. And if you see down here, that's exactly what they did. They took $379, subtract out the average cost of $289, and your gross profit is $90. Okay. Now you have 3 units, you sold 1. So you have 2 units remaining. So you take that average cost, $289, multiply it by 2, and that gives you your ending inventory balance of $578. So that's first problem. And that's just kind of doing some basics to understand the 3 different cost flow methods. So let's move on to the next problem. All right, the next problem we're looking at is using the perpetual inventory system and using FIFO. It's going to give us a series of beginning inventory purchases and sales for the month of January. And it wants us to calculate the cost of merchandise sold on January 25th and what our ending inventory balance is as of January 31st. Okay. So we're using the FIFO method. So again, the FIFO method assumes that your first purchases are your first items sold, and your ending inventory is comprised of your most recent purchases. Okay, so if we see right here, we have our beginning inventory for January 1st, which was 80 units at a cost of $23 per unit. On January 9th, we sold 55 units. Then on January 13th, we did another purchase. We purchased 63 more units at a cost of $27 per unit. And then on January 5th, we did a second sale where we sold a total of 30 units. For us to be able to calculate the cost of merchandise sold using the FIFO method, we're going to have to go ahead and do the math of all the items sold. So let's go down here, and it's got a great breakout of the cost of merchandise sold. So with FIFO, we're going to, we take the first items sold, first items purchased or first items sold. All right. So first thing first, we have to calculate this transaction right here. So on January 9th, we sold 55 units. All right. So the only inventory we had on hand when we did the sale on January 29th were the 80 units at $23 a unit. All right. So let's go ahead and get that math out of the way. If we had 80 units on hand, all right, at $23 a unit, and we sold 55, then that means we have a remaining 25 units on hand at $23 a unit. Okay. So 80 minus 55 means that we, out of the 80 units after this transaction right here, okay, we have 25 units left of the $23 a unit, okay? So if you come down here to be able to calculate the cost of merchandise sold on the January 25th, using the FIFO, which is your first items purchased or your first items sold. All right, the first thing we're going to do is take the remaining 25 units that we had on hand after this transaction. Okay, we're going to take those 25 units at $23 a unit, and it's going to total $575. All right, now we sold 30 units total on January 25th, because again, it's asking us what is the cost of merchandise sold on the transaction that occurred on January 25th. All right. So we went ahead and subtracted out the total of units that were sold out of this transaction. So we know there's 25 units left over at $23 a unit. So we pull that down and do that math. So 25 times units times $23 equals $575. Now we take an additional 5 units out of this transaction right here. Okay. All right. So what we're going to do at this point is now we know we have to take another 5. We need another 5 units, and it's going to come out of these units, this unit right here. All right. So if you look down here, we see the 5 units at $27 a unit. All right. We're going to go ahead and do that math and multiply it out, and equals $135. So 25 units at 23 plus 5 units at 27 equals a total number of 30 units, which is what we sold on January 25th, was 30 units. All right, when we multiply it out and then add it together, our total cost of goods sold for the sales transaction that occurred on January 25th is $710. Now, the next question it asks is, what is your ending inventory on January 31st? All right, so based on the 2 sales transactions, all right, on January 9th, we sold 55 units, and on January 25th, we sold 30 units. That's a total of 85 units that we sold in the month of January. All right, now under the FIFO method, that first in, first out. So your first purchases are first out. So this inventory has been sold. We have no more inventory left on the shelves as of January 31st that was purchased for $23. The only thing we have remaining on the shelf is the inventory that we purchased on January 13th at $27 a unit. All right. So if we sold a total of 85 units, then that means all 80 units are gone, minus 5 units out of the 63 units. So 63 units minus 5 equals 58 units. So if you look down here, it's exactly what they did. They took the 58 remaining units left and multiplied it by 27, and it gave us our inventory balance of 1,566. So you can look at it a couple of different ways. Okay, so let's look at total units available. So we had 80 units at the beginning of the month, and we purchased 63 more units. So we had a total of 143 units available for sale. Okay. Our total inventory so if we had 143 units available, all right, so we take that 143, we go ahead and subtract out the 55 units sold on January 9th, and then subtract out the 30 units sold on January 25th. That leaves us with 58 units. So again, if we take 80 plus 63, all right, that's our beginning inventory balance, plus our additional purchase that we made on January 13th. All right, the total number of units we had available to sell for the month of January was 143 units. Of that 143 units, we sold 85. So 143 minus 85 equals 58. So we had 58 units on hand as of January 31st. Using the Fifo method, of the 58 units available on hand, all of them would have come out of the purchase that we made on January 13th, where it was $27 a unit. So we would take 58 times 27, because in FIFO, under FIFO, your ending inventory is always made up of your most recent purchases. Let's move on to the next problem. All right, so same type of problem, except in this scenario, we're using Lifo, which is last in, first out. So again, Lifo means that it assumes that the last items purchased are the first items sold, and your ending inventory balance is made up of your earlier or your first purchases. So it's kind of the opposite of FIFO. Not kind of, it is the opposite. All right, so again, it's asking us to determine the cost of merchandise sold on January 21st, and then it's asking us to determine the ending inventory balance as of January 31st. All right, so on January 21st, a total of 86 units were sold. All right, so under Lifo, the last items purchased are the first items sold. So the last item purchased was on January 11th, where we purchased 102 units at $19 a unit. So under Lifo, the 86 units we sold on January 21st are comprised of these units because these are the last units purchased. All right, so if you take 86 units times $19 a unit, it equals $1,634. And you see that right here. Now, how to come up with the ending inventory balance. Okay, again, let's start out with the total number of units available for the month of January. So we'll take 92 plus the 102 equals 194 units. There's a total of 194 units available for sale in the month of January. Now we sold, all right, 74 units on January 5th. We sold, and then we sold another 86 units on January 21st. Okay, leaving us with only 34 units on hand at the end of January. So if you look right here, 34 units. Now now we've got to figure out of the 34 units left on hand, how much had a value of $19 a unit and how much had a value of $15 a unit. So let's kind of start here in this transaction right here on January 5th. So on January 5th, we sold 74 units. The only inventory we had on hand during the time of that transaction were the units at a value of $15 a unit. So let's go ahead and take 92, all right, 92 units, right, and subtract out 74. Okay, that's going to give us 18 units. So of this inventory, we had 18 units left. Now, we already know that on this transaction on January 21st, all 86 units sold came out of this inventory because it's LIFO. So last in, first out. So last item purchased are the items that are soon to be sold first. So we know all 86 units of this sales transaction came out of the inventory that was purchased for $19 per unit. All right, so we can go ahead and take 102 and minus 86. And that leaves us with 16 units. So we had 18 units at a value of 15 left and 16 units at a value of 19 left. So if we come down here and we can see the math, I kind of highlight it so your eyes can jump down to it. We do the math. We take 18 units times $15 equals $270. Then we take the 16 units times $19 and gives us a value of 304, add them together. And our ending inventory balance as of January 31st is 574. So again, LIFO is last item purchased or first item sold. So under LIFO, you assume that the last items you purchased are the first items sold. So on January 5th, sale came out of the inventory, the only inventory we had on hand, which was the inventory valued at $15 a unit. And the sale on January 21st came out of the inventory we purchased on January 11th at $19 per unit value, because these were our last items purchased. And so therefore they became the first items sold on January 21st. So we have to take what was left over under each inventory and do the math, which we did down here, to determine the ending inventory balance of $574. So let's move on to the next problem. All right. All right. So this is a problem where it's wanting us to determine the inventory cost using the 3 different methods. All right. So it gave us our beginning inventory balance and different purchases throughout the year and how many number of units and cost. All right, so again, let's look at FIFO. So when FIFO method is used, costs are included and cost of merchandise sold in order which they were purchased. Okay, so again, FIFO is like in the order of which they're purchased, because the first items purchased are assumed to be the first item sold. So it's kind of an order and purchase. So if there are 20 units of the item in the physical inventory as of December 31st. All right, now this is using the periodic inventory. I forgot to mention that. What we've been doing up to this point has been the perpetual inventory system. And this is a problem where we're using the periodic inventory system. All right, so let me reiterate the difference between perpetual and periodic. With the perpetual inventory system, with every single sales transaction, simultaneously there's a ledger entry updating the cost of merchandise sold and your ending inventory balance. Under the periodic inventory system, your cost of merchandise sold and your ending inventory balance is not updated until a physical count of the inventory has been completed. All right, so it is a different method and a different process. So in this problem, we're using the periodic inventory system, and we're going to calculate the FIFO, LIFO, and weighted average cost methods using that periodic system. All right, so if there are 20 units of the item in the physical inventory as of December 31st, the periodic inventory system is used. Determine the inventory cost using FIFO, LIFO, and the weighted average. Okay, so under the FIFO, all right, we're to assume excuse me, sorry, I had to pause recording for just a moment. I had to take a drink of water. All right, so under the FIFO, again, we assume that the first items purchased are the first items sold. So if there are only 20 units on hand as of December 31st, then we're to assume that it would be the ending inventory would be comprised of our most recent purchases. Okay, so of the 43 units totally available for sale for during that entire fiscal year, we now only have 20 units available, meaning 23 units were sold. All right, so what we're determining, we're not determining cost of merchandise sold at this point. We're just trying to determine what our inventory is. So under FIFO, if we only have 20 units on hand, then again, our ending inventory is going to be comprised of our most recent purchases. So we're immediately going to assume that of the 20 units on hand, 11 of them, all right, are from the units purchased on December 11th. So if we come down here, we see the 11 units times $5,200 a unit. Okay. All right. Now, so of course, doing our math, if we have 20 units on hand, 11 of them came from the purchase made on December 11th, then the remaining 9 units came from the purchase made on August 7th, $5,100 a unit. So we're going to have 9 units at $5,100. So 11 plus 9 equals 20, and that's how many units we have available. You see that right here. All right. So again, FIFO, your ending inventory. Okay, first in, first out. FIFO means that it assumes that your first items purchased or your first items sold. So your ending inventory balance is going to be comprised of your most recent purchases. So we're going to take all 11 units of from the purchase on December 11th and 9 of the units purchased on August 7th. And we're going to assume that's going to be what comprises of our ending inventory. So when we take 11 units times 5,200, that equals 57,200, and 9 units times 5,100 per unit equals 45,900. We add those two together, and our total ending inventory under the FIFO method equals $103, $103,100. All right, now let's switch gears. Now we're going to do the Lifo. Under the Lifo method, all right, the cost of units sold is from the most recent purchases. Okay, so your ending inventory is going to be comprised of your earlier purchases. All right, so we're going to kind of flip it. We're doing the opposite now. So if we have 20 units on hand, then the 23 units we sold came from our most recent purchases, and our ending inventory balance is going to come from our earlier purchases. So we're going to immediately assume that of the 20 units we have on hand, 13 of them came from the beginning inventory balance on January 1st. So if you look right here, we see that calculation down here. We have 13 units at times 4,800 a unit. All right, and then we're going to take the remaining 7 units out of the purchase made on August 7th. All right, so if you see here, we have 7 units times 5,100. So 7 times 5,100 equals 35,700 plus the 62,400. All right, is going to give you an ending inventory balance of 98,100. All right, so that is how you determine your ending inventory balance under the periodic inventory system. All right, the last one we're going to look at is your weighted average cost. Now, again, your weighted average cost, you average out the cost of your units. Okay, so we take the total costs of your inventory, and right here they've already added it up for us, which is 216,500. All right, and you divide that by your total number of units available for sale for the month, which was 43 units. We had a total of 43 units available for sale the month. I mean, not the month, I'm sorry, we're doing a whole year. We had a total of 43 units available for sale for the year. Okay, so we take the total cost of all the inventory and divide it by the total number of units that were available for sale during that period. Then our average cost per unit was $5,034.88. All right. If we had only 20 units available as of December 31st, then we would take that average cost of $5,034.88 and multiply it by 20. All right. Now, it did tell us to round per unit cost to two decimal places, and then final your answer to the nearest whole dollar. So it did not want us to use decimal places. All right, but if you take 20 times $5,034.88, it actually equals $100,697.60, and wanted you to go ahead and round to the nearest whole dollar. So your answer is actually going to be 100,698. But again, just so you know, 20 times $5,034.88 actually equals $100,697.60. So if you guys were getting that answer and trying to plug it in, or getting an answer like that, trying to plug it in, it was like saying, nope, wrong, round to the nearest whole dollar, because that's what it tells you to do here in bold. All right, nearest whole dollar. So we're going to round it up, and the weighted average cost of your inventory as of December 31st is $100,698. So again, how we came to that conclusion, we take our total inventory cost for the year, which is $216,500, divide that by the total units that were available for sale during that year, which is 43 units, and that gives you an average cost of $5,034.88. Multiply that by the total units you have on hand on December 31st, and that gives you your ending inventory balance under the weighted average. Okay. All right, so we'll move on to the next problem. Okay, this is regarding to lower of cost or market method. Okay, here you're going to have two items. Okay, and you're going to have your inventory quantity and your cost per unit, and then the market value per unit. And what it's wanting you to do is determine the lower of cost or market. Which one's lower, the cost or the market? Okay, to determine the value of the inventory. Okay, all right, so the first thing you're going to do is, let's look down here. All right, we have a little table set up where you can kind of see it. First thing you're going to do is for item number 1, you're going to take the quantity of 87 and you're going to multiply it out by your cost per unit, which was 2,958. Then you're going to multiply, 2,523, excuse me. And then you're going to take your total quantity of 87 and you're going to multiply it by your market value, which was 2,958. Which one was the lower? Okay. All right. The lower was the cost method. So the cost actually was lower in this situation. So you're going to put that value right here. Okay. So you're going to select that value. Then you're going to do the same thing for the second item. You're going to take the total inventory quantity and multiply it by the cost, and then multiply it by the market value and determine which one's less. And it's obvious which one's going to be less. All right. So what you do is you basically make sure that you take the lower of the two. You take the lower of the cost or the lower of the market, whichever one's lower. So in item number 1, the cost per unit was less. And in item number 2, the market value per unit was less. So you take those two values and add them together. And that is the amount you put in to determine the value of the inventory at the lower of cost or market. That's all you do in this problem. That's it. All right. So let's move on to the next problem. All right. Now, this is talking about financial analysis, and we have two analysis that we use for inventory. We have inventory turnover and then days sales and inventory. Okay. So to determine the inventory turnover, all right, okay, so what is, first of all, let's look at this one, inventory turnover. What is inventory turnover? It's the relationship between the volume of goods sold and inventory, and it's calculated by dividing the cost of goods sold by the average inventory. So it basically determines how well a company is managing their inventory, how many times they're able to buy and sell their inventory in a period of time. Okay, so the first thing we have to do to determine your inventory turnover is we have to go ahead and calculate the average inventory. So average inventory is simple. You take the beginning year inventory plus the end of year inventory and divide it by 2. And you can see that right here. So if we look at it right here, here's an example of calculating the average inventory for the year ending in 4. Okay. All right, so then you take that average inventory and you divide that into your cost of merchandise sold. So if you look at that right here, you see that calculation right here. So you take the total cost of merchandise sold, divided it by that average inventory, and that gives you your inventory turnover of 3.2. All right, you do that for both the year ending in 4 and the year ending in 3. And you compare the two. So the higher the inventory turnover rate, the better, because that's showing that that company is being more efficient in managing their inventory. So basically they were able to turn their inventory over 3.2 times in the year ending in 4, but they were only able to turn their inventory over 2.9 times. So that's the total number of times they can buy and sell their inventory. Okay, how many times are they able to completely buy and sell out their inventory within a period of time? And this was like during an entire year. All right. So again, the higher the turnover, the more efficiently the company is managing their inventory. All right. The next analysis we're going to do is days sales. And this is how many days it takes for them to buy, sell, and replace their inventory. Okay, so all right, so then let's look at the calculation for days sales. Okay. So let's see here. All right, so again, this is a relationship between the volume of sales and inventory, and it is calculated by dividing the average inventory by the average daily cost of goods sold. All right, so how do we get the average daily cost of goods sold? All right, well, let's look at this right here. We get an example of it right here. The average daily cost of merchandise sold is you take the total cost of merchandise sold, which here is 981,120, and divide it by the total number of days in a year. All right, so their average daily cost of merchandise sold is $2,688. So on an average, their cost of merchandise sold per day equals out to an average of $2,688 per day. All right. Again, you have to calculate your average inventory. So again, we calculate average inventory by taking the beginning year inventory, adding it to the end of your inventory and dividing it by 2. And that is your average inventory. So you take that average inventory of 306,600 divided by your daily cost of merchandise sold, which is 2,688. And that gives you days in sales and inventory of $114 and 114.1 days, 114.1 days. That is your average day sales and inventory. So again, you in this situation, whereas in the inventory turnover, the higher the number, the better. And days in sales inventory, the lower the number, the better, because that means that your inventory is taking fewer days to sell. So again, days in sales, the days in sales and inventory is a measure of how quickly you can purchase, sell, and replace your inventory. All right, so it's another way of looking at inventory turnover, but you're really kind of like looking at it like how many days does it take for me to do it? So inventory turnover says how many times a year did I turn my inventory over? Days sales determines how many days does it take me to sell all of my inventory out. Okay. So in this situation, the lower the number, the better, because it's taking you fewer days to sell your inventory, meaning you're selling it faster. And that's always a good thing. So if you look at the trend for days sales and inventory between year 3 and year 4, year 4, you were able to do it in 114 days, where in year 3, it took you 125 days. So the trend from year 3 to year 4 is a favorable trend because you were able to sell your inventory faster. In other words, it's set on your shelves for a shorter amount of time. All right. So, all right, that is it. That is all the problems I'm going to do in this video. To go over some examples of your homework problems. I think this is plenty to kind of help you get started and to help you work out all the problems on your homework. So again, if you guys have any questions or concerns, feel free to email me.